Hey everybody, Preston Bryn here with this special Labor Day weekend edition of our weekly roundup. This is for the trading week ending August 30, 2019. So we come to the close of Q2. What I've got on the screen here is a monthly chart. I think it's kind of, at the end of every quarter, I like to kind of take a step back and just kind of see exactly what the heck is going on. And we've seen a lot of volatility come back into the market, relative speaking. And we've seen a lot more chop price action since we went through the end of January 2018. So as you can see on this chart, I got a lot of activity on the screen. I'll talk about it in just 1 minute. But I want to go through a couple of key levels here as we go into the first trading week of September. I will remind everybody that September typically is one of the worst months of the year. August is also one of the poorer performing months of the year. But if you look at September and you go back, in fact, I saw a recent article that had said that September since 1950 produced annualized returns of a minus 5.51%, going back since 1950. So that's a long time ago. That shows on the surface September tends to not be a very strong month. Once we have the go back to school, all the traders back from summer holidays kind of thing. So it tends to be very suspect. In fact, if you look at September's during bear market periods, secular bear markets would tend to last 5, 7, 8 years or longer. So if we go back to like the 1970, 1969 to 1980 area, that 10-year period, and then another 10-year period, say from the year 2000 to 2012, you'll see that September has produced annualized returns of a minus 13.82%, almost minus 14% annualized return for the month of September. And meanwhile, September's during secular bull markets like what we're in now have produced annualized returns of about a minus 35 basis points. So while it's not growing, it's really not falling. It would suggest in a secular bull market, which is what we're in now, this could just be a little bit more of the same that we've seen over the past 2 or 3 weeks, with the markets really kind of going within about a 120-point range, up and down, up and down. So not that September is designed to go down, it's just it seems to be based on how money flows and where we come in going into Q3, a lot of things could happen. Okay. Also, one other point I want to make, we've seen yields in the 10-year move from about a 3.25% rate level down to about a buck and a half, 1.5. That's a huge drop, folks. And the Feds have kind of moved from this rate hiking campaign to finally, Jerome Power Ranger Boom Boom Powell has finally agreed that lower Fed funds rates may be necessary. In fact, we just did a cut, but they're still fighting it tooth and nail. The bond market wants more cuts. And in my humble opinion, I think the Feds need to lower rates. But if you look at the talking heads on TV, you'll have some people make the argument that why should the Feds lower rates? Because we got a strong economy. We're still expanding. I'll bet we just had a contractionary PMI come out last week, but the U.S. for all practical purposes is still expanding. So why cut rates? But the issue is we've got one of these things where uh, it's a relative problem. Central bankers all over the planet are dovish, everywhere. They're all cutting rates. So if we do nothing, all that does is strengthen our dollar, okay? Because money continues to flow from other countries into the US. And by strengthening our dollar, weakens larger corporation profits. It also tends to drive down commodity prices, which tends to keep inflation lower than normal, okay? It tends to lower everything. So I think the Feds are a day late and a dollar short on this whole thing, and I blame it on Boom Boom Powell. So in some respects, Trump has it right in this particular case. And the Feds have kind of created this inverted yield curve. All they've got to do is cut the rates a little bit more aggressively, and that inverted yield curve will go away. Now, again, we're in a secular bull market. That does not mean that we can't have a short duration bear market, like we saw in December of 2019, this past 2018. I mean, the Russell was down a pretty good bit. I mean, it was down, uh, what, about 27%, I think. So that was in a bear market, and the S&P 500, the SPX, almost went into a bear market by just a couple of ticks. It could have gone in there. So the markets are basically screaming. The bond market, which I think is a much smarter market than the equity market anyway, is screaming that the Feds need to be a little bit more aggressive in getting the rates lower to get inflation back on the books again. Okay, so that's one of the things that if they don't do that, this threat of disinflation and a stronger dollar and lowering commodity prices is going to continue to weigh on the financial markets. Okay, so that's a little bit about what I'm kind of seeing at a high end level. Now, we've got coming up here, we've got a lot of potential roadblocks coming up in the month of September. Remember, I said September is traditionally, over the past couple of decades, heck, since going back to 1950, it has produced annualized returns of a negative 5.51% annualized. So that does not bode well left to its own devices the month of September. Now, if you also look at September, we got the ECB coming out in a couple of weeks. And they're all over the press saying that they're going to do a lot more stimulus. So that's going to put even more pressure on Boom Boom Powell, our illustrious Fed chair, to cut rates here too. And then we've got the Fed obviously meeting the week after the ECB, so they're going to tee it up for the Feds. We got Q3 earnings getting ready to kick off in a few weeks. Okay, or in we're going to have those once we get through the month of September. We're going to have Q3 earnings, so that's going to be something that is going to really start to show up and get a better view of how these China trade tariffs are impacting or not impacting the U.S. And over this Labor Day weekend, we see the Trump administration's putting more tariffs on China. So all of this is just going to keep the markets relatively unstable. So now looking at this chart here, finally, you can see this green upsloping line. So this is the really in what I would view as a secular bull market. And if I blow it up, again, it's a monthly chart. I'm going to leave everything on the screen for now, and then I'll take some of the indicators and price levels off so it'll be a little bit cleaner to see. You can see here that we've done fairly well. Going back to '09. I mean, it's just clearly been a time to be bullish. I mean, that's kind of what you want to do. And we've touched this line here. We came back over here when we started kicking it off in 2012, 2011. We came close here during the Trump election. I mean, you can see the level right here when we had the pre-Brexit vote, and then we had the Trump election here. You can see in December we came down on this monthly chart and kind of just touched the line a little bit and then bounce back up. And now you can see we're right up in this level here. So we can still come down a strong amount, actually take away all of our 2019 gains and still be on this secular bull market upsloping trend line. Okay, so we've still got a lot of downside that we could do, a lot of significant pain for near-term and short-term duration traders can experience, and yet still be in a secular bull market. Okay, so just understand that. I don't see at any point here any signs of a near-term recession, nor do I see us going into a longer duration bear market, but I do see there's a lot of potential chop here going forward. Okay, so if we come in and let's go down to a weekly chart and just kind of take a look at it from that perspective here. You're going to see here again on this weekly chart down below, you can see those key levels that kicked off the overnight Trump election lows at 2028, the post-Brexit vote 1981. You can see where we were pre-Brexit and then post-Brexit, and then everything just kind of shot higher. Okay, and now you can see we've had 4 weeks in a row of red candles, and then this past week. We had a strong market kind of move back up to a key level here. And I'll show you these key levels as we just start to zoom in on these a little bit more closer term here view of this. I'll blow it up so you guys with bad eyesight can see it. You can see here, we had a bullish engulfing pattern here on a weekly chart. Okay, so let me just highlight this for you guys. You can see that was the low right there. and we made a lower low here this previous week. This was the high 2 weeks ago, and this was the high this week. So we've engulfed this candle right here, and we engulfed it from a bullish perspective because we closed up near the top here. So that would suggest near term there's momentum to the upside. Okay, that's what that bullish engulfing pattern would suggest. On this weekly chart, as I told our members, we had a cross here and a cross here, which gave us that what we call a bed, a bearish divergence, and it's not a poor man's bed as we term it, but it's a regular bed, and that told us that we're going to experience some more downside action. How much, you never know, but we came down and we had a pretty significant move lower in a very short period of time. So we got bearish here going into the month of May. And then going into the month of August, I was also suggesting we were getting bearish, and I was moving our members more into a bearish frame of mind. You can see that resistance colored bar right there that I said as we got into it. We were here for literally a month for all of these candles right here, and then we finally gave it up. Okay, and we took out these lows right here, and then away we went. Right, and then we just kind of formed this low down here, just above 2,800 at the 2810 level. So what does that mean now, and where are we looking? So let me just clear up my screen here just real quick and get some of this off. I am, as usual, when I travel, weather or the markets or both tend to go crazy. So I left my office is just north of Miami. I'm doing a seminar overseas, and I'm trying to get back to Miami, but Hurricane Dorian does not want me to come back yet, and I'm not. I guess neither do the airlines. They're not flying into Miami, so I had to postpone until sometime probably the middle of this week. So hence, I'm doing this for my Surface Pro in a hotel over in Europe right now. But I had some really great seminars and some coaching sessions over here, and it was really a lot of fun. Got a chance to meet some of my hedge fund buddies as well, so that's always enjoyable. But hopefully everybody in the East Coast, especially in the Southeast, is staying safe with this monster hurricane coming up. So anyway, let's come back in. Let's go to a daily chart. You can see on this daily chart here the chop. I mean, and let's just step it out so that you can just see how this thing has been moving, right? I mean, you can just see the movement. I mean, it's crazy. It's all over the place. Let me just get that off the screen right there. So you can see the movement of the markets. We've had this huge move lower. We moved below a pretty significant support zone intraday on this daily chart. We went down significantly, and a lot of buyers came in at the 27.75, and you can see where we closed up here. So my support shaded zone here held us up, but I've got a stronger support area around the 2800 to 2820. That's that colored zone there. So you can see the box that we're in, okay? And this box, and I'll just highlight it here again for you guys, is something like this. I mean, this is the box right here, okay? And we've been in this zone right around 2820 to 2940, which, as I said, is about 120 points, 120 S&P points. And we're just meeting a lot of overhead resistance, coming down, and we're getting a lot of strong support up in this level here. So it's compressed this market, but in a fairly wide range, 120 points. We will break, guys. Now, what are the odds of a break to the upside as a break to the downside? Believe it or not, the odds favor a break to the upside, although we're just a tweet or two away from breaking the downside. Should we break the downside, we're going to test the lower 2700 area. Now, I told our members right back over here, I was expecting a 2650 to 2700 run. We came down to 2760. All right, so I missed it by about 60 points to 110 points because I thought we would come back down into this range down here. But we had buyers step back in, and now we're stuck and we're sandwiched in this zone here. Now we could chop around here a bit. It's going to take a lot of energy to move us north of this level here. A dovish ECB, a dovish Fed, and they get off their stance of just saying transitory factors, because transitory means that while inflation is not there anymore, or at least lower right now, we expect to come back relatively soon. The bond market is saying something entirely different. bond market is saying au contraire. It's going to be like this for a little bit longer unless you get more aggressive in cutting rates. But if the Feds do that and the ECB does that, and we get some nice from Trump, because remember, China is supposed to come over and visit Trump's team here second or third week in September. And if Trump and China feel like there is some progress, then that'll clearly give us the energy to come up here and actually challenge these all-time highs. And I've on record as saying that I think we're going to make new all-time highs before the end of this year. Okay. But I'm also on record as saying I could see us coming down and visit the 2700 to 2650 area. And that's what I thought we would do as we went into the month of August. So that tees it up for a very wide range. I mean, literally a 300 point, 350 point wide range from the peak to trough from September, the month of September going into the beginning of October. And let's not forget, we get the Brexit possibility of a hard Brexit on Halloween in October. So this just all gears this up to be a very volatile, choppy period of time for the markets. Okay. Now, for those of our members, we've got some trades that are playing out. We put on what I call a foo-bar fly, which is working very nicely in this area here, where there's really not much work to it. It's more of a hedge fly than anything else. So that's working out fairly nicely. Volatility we do know is elevated. The bond market, it's still tremendously elevated. I'm more apt to short the bond market than go long, but I want to give it a few days as we go into a new month and just kind of see how this thing shakes itself out. Okay, I want to see where that plays itself out. From a currency standpoint, the dollar is just getting stronger and stronger. And you can see here on this currency, where we've got we're just continuing to move higher on this thing. And if I were to put a regression line on this, I mean, you could just see the movement, right? And on this regression line, as I've always said, when you get near the peak of the regression line, don't be a buyer of the dollar, because I expect it to come back towards the central mode of this regression line. And if we get down to the southern, then you want to be a buyer of a dollar. So this would suggest here you want to be long euro dollar, probably going into next week, no matter how illogical that may sound, if the ECB is going to be cutting rates, because it's going to be harder for the dollar to maintain north of this blue line on this regression channel. Okay. If we look at the euro, it's going to be just the opposite. Now, I like a cheap euro now because I am over in Europe. And it really suits my taste quite well because my dollar is going stronger. But the markets aren't going to eventually like it. They're going to get tired of it. You can see right here, we could not hold a 200 EMA, and we're back down to the central mean of the regression channel. Okay. We're coming in looking like we're trying to form an Elliott wave 5 down at the bottom down here. I don't see any indicator that would suggest we're going to get a big bounce. So if we do get a bounce, it's probably going to be an opportunity, a counter trend mode for more shorts to come into the market with euro. Near term, we could get a little bit of a bounce in the euro and a little bit of a pushback in the dollar. But I think longer term, unless the Feds and the ECB work in concert together, it's not going to work out the way they want. Okay. Excuse me. If we look at gold, it's doing exactly, our trigger buy price for gold was right around 1372. All right. Excuse me. This was our trigger price for gold, and it's just taken off to the upside. Now, I got all of our members, and a lot of our members played gold, but I had strongly encouraged members to go long silver. You can see on a relative basis, silver has outperformed gold. Hang on just 1 minute. I got to get a little bit of water here. So let me do this here. I'm going to mute my mic for a second. Okay, sorry guys, I'm back with you. I had a coughing spell here. So now you can see silver's been the play, okay? And I had all of our members getting long silver or SLV. And we made a great amount of money on it. And we were getting in down around this level down here. We're even down around the 13 level. If I look at SLV, where is SLV? Oh, here we go, right here. It's at 17.15. And we were getting long SLV down around the 12 and a half level. So from 12 and a half to almost 17 and a half, about 17.15, right? So that's 4 or 5 points. That's a solid return, okay, on a relative basis. You can see here with the divergences, there are none on this big move higher. We gapped up and we just keep moving higher. In fact, SLV and silver closed up on down days and even on up days. So that shows money is coming in. You can see the MACD porpoising higher. That's a very bullish sign. Just like over here, MACD was porpoising lower. This was a time where if you weren't looking at going long silver, this would be an excellent entry point as we started to move back higher again. Okay, and we were getting long, and I was suggesting to our members that we get that they follow long here, and it's turned out to be a nice trade. Now another one for our members that we made a ton of money on. And I think there's going to be another opportunity here is palladium. On Friday, it was up almost 60 points. Remember, it's $100 a point. That was about $6,000 a contract. Don't want to go long, want to go short. I'd love to see this thing come up here and make new highs. I mean, that did nothing would make me happier than to see that right there. If we can climb up to that 1600 level, I'm going to be a shorter. I'm going to be short in this market. Even if we can get up above the 1550 area, I'm going to be dipping my toe in the water looking at shorts because I think that's kind of how we're going to play it. So for members, just kind of stand by on that. Let's see how that thing plays itself out. Meanwhile, the oil market is still sitting at the area I've been talking about all damn year long, right in the mid 50s. Okay. We move above it, we come back down below it, we move up above it, and the 50s is kind of like Velcro. I think the near-term direction of oil is more down than up, but I think we got a solid support around the psychological barrier of 50. So for our members that love to trade oil, it's a great play. We've played it, and at least some of the suggestions I put out there have been very good for oil. Okay, so and then we see some things. I see a lot of things in the ag space, and I also see things in meats and softs. But there's nothing that I want to trade right now. Um, but for our members, we're going to be taking a look at as we crank up into the month of September, just where the opportunities are going to present themselves for us. I think it's going to be great. Now, for members, I am trying my best to work with the airlines to get back. I'm in Austria, in working with Austrian Airlines to get back down to Miami. It depends on where Dorian goes and what its track is. So I'll stay in touch with you in our chat room. If you're not a member, I highly encourage you to come in. Just a few of our trades would, pay for our membership for years. And we're getting a lot of members coming in, especially international, which is good because that's kind of what's driving the markets right now anyway. All right, everybody, I will see you in our chat room on Tuesday. Have a great long holiday weekend. And those in the Southeast, please be safe. And meanwhile, I'll try and make my way back to Miami when I can get a flight out when this hurricane clears the area. Take care, folks. Ciao.